Are you considering purchasing a home in 2022? Perhaps it's a goal that you want striking off the top of your dream goal, or maybe you just want to get a little bit of information to help you make a better informed decision. Either way, you're probably wondering, what's the real estate outlook look like for 2022? Will we see another record setting year of appreciation? How will those interest rates look for the financing slash lending? And will I even have any inventory to choose from? Well, we're going to talk about all of that. In today's video, I'll tell you why I believe we are poised and in position to see another strong year in real estate. Why I believe that we'll still be in position to see strong appreciation in the real estate market. And lastly, why I believe that a housing crash is highly unlikely in today's environment. That's right. So we're going to talk about interest rates. We'll talk about job growth. We'll talk about foreign buyers slash investors, and all things that you probably should consider when thinking of purchasing a house in 2022. Uh, I'm B. John with the Harvest Group. Yes, I am a local licensed real estate broker here in South Carolina, but the purpose of this video is not to tell you to sell your house or buy a home. It's simply to share information to help you make an informed decision, whether you should wait, whether you should buy, whether you should sell. Just weigh out your options. The very first thing I want to speak about in today's video will be one of the key factors, and that is demographics. We now have over 72 million millennials. And guess what? They are now reaching that prime buying age for a first-time home buyer. Believe it or not, that average age for a first-time home buyer is around 33 years old. And you may be thinking, well, how are they affording these homes? They're expensive in the same market that we're shopping in. Well, a lot of the millennial generation, they had the opportunity, and what a lot of folks were doing were actually staying at home with their parents a little bit longer. This has given them the opportunity not only to enter the marketplace by being able to save some money, but fortunately for them, the jobs have also been paying a little bit more. So now, when you combine the ability to save money on top of having a better paying job, it gives them a little bit more buying power coming in today's market trying to purchase. Um, what I'm noticing, and a lot of people are predicting for this to be the front end of a strong appreciation market. So what a lot of the older and previous generations are doing, they're actually passing down money via trust. They see the housing continuing to rise, and out of fear for the younger millennial generation getting priced out, they're transferring money so they can have that opportunity to have their piece of home ownership before they get priced out of today's market. We also have foreign buyers as a demographics. Now, over the last year and a half, the competition hasn't been as fierce simply because they hadn't been able to travel, much less buy property. So as the coronavirus, hopefully the cases reduce the first half of the year, the Omicron and all different variants as well. As that reduced, that should loosen up the travel restraints that is there, giving those investors opportunity to purchase property again. Now, obviously, whenever there's more buyers and the same amount of inventory, that may put more stress on the inventory levels, causing the prices to increase. We also have Canadian buyers. Canadian buyers have just been flocking to the states here, Florida, South Carolina, where it's warmer, because, hey, it's warm weather. Who doesn't like to have warm weather? At the same time, we have the institutional buyers. These are the big boys who have money and pension and other assets. And what they're starting to do is they're starting to move those assets from more volatile categories like stocks and putting it towards assets like real estate. Why? Because, well, one reason is inflation. Everyone wants to keep their money above inflation. And what do these hedge funds try to provide? They try to provide a more fixed rate of return for their investors. So as we see inflation rise, as it probably will, at least for 2022 as they continue to talk about rate hikes, but you're more than likely are going to see more people leave those more volatile assets and put it into something sustainable so they can have the longer term appreciation and have a set rate of return for their clients. These are going to be your institutional buyers. Now, I know a lot of you are looking to purchase, so you probably don't follow the rental market quite as closely, but I do. In the last year and a half, especially, the rental prices have continued to go up and up and up and up some more. A few reasons are playing a part of that, but this kind of highlights the last point that I was trying to make is these foreign buyers. There are actually buyers and foreign buyers who've been buying property, having them vacant, and now starting to rent them out at a loss. Why? Why would anybody want to lose money? It's because they have the picture of another 5 to 10 year goal, and they see the appreciation in the house prices rising. Obviously, these rental prices are going up due to supply and demand. We all know that. But this is just another key highlight that the demand for the housing is here. Now, at the moment, depending on where you are, we're about 4 to 6 million homes behind building in regards to where we should be. We have rising building costs. We have restrictions being put on contractors. Land is selling at a premium. It is very difficult for contractors to build at a rapid pace. Normally, in a healthy market, what we should see or expect is about 1 million homes being built, give or take, per year. That would mean it would take about 4 to 5 years on average just to get the new construction up to a healthy level to catch up. And we also have the baby boomers. Now, as time goes, prayerfully and luckily, these baby boomers have lived a little bit longer than what they and everyone else probably was initially expected. And if they're here, they also typically, people who want to entertain being in a different home, they're going to look at what their options are in today's market, and what do they see? They see home prices that are much higher than what they're comfortable paying and what their payments already are, and they see the lack thereof the inventory with it being there. So naturally, these boomers that typically were, some inventory or opportunity for inventories rather, they're looking at the market. That, accompanied with the rise in construction costs, accompanied with the millennials that are hitting, these baby boomers are getting quite comfortable. At the beginning of the pandemic, the Fed lowered the fund rate to 0, and that caused the interest rates to go down. They did say that they were going to start buying back mortgage-backed securities and bonds, and this, again, is making the interest rates go lower. Even though they did say they're going to start tapering, and this is supposed to start in March, historically, the interest rates are still at an all-time low. It wasn't until just recently when we started to see an increase in interest rates, but interest rates are especially low historically. Interest rates are now in the low 3%, maybe the high 2s, depending on what type of loan you're looking to get. But at the same time, historically, these interest rates are extremely low. Now, the majority of people that actually know what they're talking about think the interest rates will fluctuate between 3.375 upwards to 3.625 on the high end. Now, one thing that I want to make sure that we keep on the forefront of the interest rate is also how we have to pay back. Let me explain. The Fed, the Treasury, makes their payment on their debt based on where the current interest rates are. And that's estimated to be about $31 trillion worth of debt. So, if the interest rates continue to rise, they'll be paying even more money to service their own debt. Newsflash, we already don't have enough money to service our own debt, which will lead into another issue, So at the end of the day, the Fed's raising the rates and raising the Fed fund rate, there's only but so much they can do and only so much they can raise it before it stops to make sense. And the main driver of the housing market is supply and demand. Until the supply can meet the demand, we're going to have a shortage there of inventory. And not to mention, the housing inventory is now at a 30-year low. And not only that, the average tenure has gone from 4.5 years to 10 years. What that means is people are staying put. They're staying in their homes a little bit longer. Whereas before, on average of 4.5, 5 years, people are looking to make a move, looking to change areas, looking to make upgrades, downgrades. People are putting are putting some strong roots in their home that they're in. So obviously that means there's going to be less opportunities for prospects and people who are looking to buy in the housing market, especially if you're in states where the property taxes is paid, is based off the price that you paid. So in a lot of cases, it doesn't make too much sense for homeowners to leave the property that they're already in, that they're comfortable with. They're a low interest rate. Many times it's locked. It's a fixed rate. So to go to having to get financing and possibly pay higher property taxes, it just doesn't make that much sense for a lot of people. Now, if you're watching this and you're wondering, what do I need to do to get in position? The very first thing we want to do is consult with a mortgage professional and get ourselves pre-approved. I'm not talking pre-qualified. That just means you pick up the phone, answer some questions. I mean full-blown, send them your W-2s, let them look at your tax returns. Make sure that you're comfortable and you know that once you have this pre-approval, we can afford it. They'll let you know what the payments can be, give you the whole full-blown experience that can make you feel comfortable as a buyer in today's market. Now, if you need a little help and direction on which lender to choose, just schedule an appointment, because every lender does not offer the same program, product, nor do they have the same rate. I appreciate you for watching this video. If you have any questions or concerns, and again, there will be a link attached to this where you can schedule a time, just reach out, and I look forward to connecting with you. If no one told you that they love you today, John with the Harvest Group loves you. Let's continue to live, learn, and grow together. Until next time.